Welcome to this week's 7x Investors Look Ahead. This is where we'll take a look at a currency pair, an index, or a commodity like gold or oil, and give you our outlooks of what we see coming this week. Before doing that, we'd like to share with you a little bit about 7x Investors. It's a platform where you can develop a free account and join our community. In that community, you can be able to have free trainings, which we hold every Wednesday. You can also gain knowledge from other traders that are in the 7x community, or even in the other communities such as Alpha Trader or 7x Futures. As you attend the weekly trainings, you can be able to get a more in-depth understanding of what kind of trader you would like to become, whether it be in futures or in forex or CFDs. Once you decide what you'd like to do, we have specialized trainers which will go through step by step on how to become a proficient, profitable trader. We have Cordell Stevens in the Alpha Trader section, which deals with trading CFDs or currencies. And we have Dan Kelly in 7x Futures, which trades futures in the NASDAQ, the S&P, and gold. At the end of this video, we encourage you to click the link below, which will take you to our website, and you can set up that free account. Also, subscribe, like, and turn on notifications of the site so that you can get notified every time we release our week ahead video. Now let's take a look on what's ahead. Welcome to this week's Look Ahead. This is for the week of September 4th, 2023. Now we're going to start with non-farm payrolls. We see here that the average hourly earnings, and let me just preference this by saying that I know that this is not an accurate number. It's why they have to revise it every month. But we're going to take it and use it because it's what markets use. So we're looking at average hourly earnings month over month came in at 0.2%, expected 0.3%, previous 0.4%. So down quite a bit. Again, we're looking at year over year, 4.3%, previous 4.4%. These numbers are going the way the Fed wants them to, but what does it mean? It means a drop in the velocity of money. It means people aren't working as many hours, and so they're not earning as much, and so money is not moving through the system as much. We come down here to the big number, which is the unemployment rate. So the unemployment rate came in at 3.8%, previous 3.5%, and was expected at 3.5%. This was the surprise number, and here's the reason why. The Fed has been keeping their eyes on this number to watch it start to rise, and they got their first indication. Now, does this mean that the Fed is going to hold rates, or are they going to raise them again in November? Don't know. I think it's more data dependent than anything. And so we're just going to have to see what kind of data comes out in October and November. And so it's more data dependent. We got a larger than expected number on 187 versus previous 157, expected 170. That caused markets to go up a little bit, but that number right here turned the markets around and they headed back down on Friday. And so that's why that number there is indicating, one, that deflation or possibly recession has already begun, because that is a lagging number. It's not a forward-looking, it's a lagging number. And unemployment rate. That's after everything is starting to crumble. That's the last thing to go. And so that's why markets started to pull back, go, we may need to go into more secure assets. And that's what we're going to look at here next, is some data that supports that. Next, I have a chart up that shows gross domestic income, or GDI, against nominal gross domestic product, or GDP. We see back here during the Great Recession over here, we see how GDI led the way and GDP followed later on. So you see how these broke down and GDI hit first, then GDP hit second. We see the same thing happening over here. GDI is leading the way. GDP is lagging. Again, Fed using lagging indicators like GDP. We want to look at GDI because that tells us a contraction in gross domestic income. And that's what this has already been in play. Now the unemployment rate is just catching up. And so once again, we're seeing contraction in spending because there is contraction in income. And so if we have contraction in income and contraction in spending, where does that lead us to next? Well, we're going to look at this chart, which contains real estate loans, commercial real estate loans, all commercial banks, commercial and industrial loans, commercial banks, and then net percentage of domestic banks tightening standards for commercial real estate loans secured by multifamily residences. We see that last one here spiking to the upside. What does that mean? That means banks are saying, you're going to have to meet a lot more stringent standards for us to give you this loan. What does that do? That cuts a lot of people out because they can no longer meet those standards, nor can they pay the interest rates which are required. I have a friend who deals in micro lending for businesses. He says so far they've been able to stay above this thing, but it's coming and it's looking awfully bad. And so what that means is they're looking at contracting their lending out. We go to these commercial industrial loans, which is in the red. We see that is down. We see that commercial real estate lending is down. That's in the blue. Everything is heading down there. We look back over here and once again, we're seeing similar outcomes here. This is contraction. This means less lending, less dollars in the system. Less dollars in the system means that dollars become more expensive, which means things like the Dixie starts going up. And that's what we're going to look at next. Last week, we had this green channel line coming down. We were expecting to break that. We did. We came back, retested it. We're starting to push out. We also put in this week this new channel. So this is the new channel we're looking at, and it's butting up right against that. You see how it matches that bottom channel. We just need to adjust that a little bit. We expect this to break out as you see it's doing right now. We expect it to break out at 105.266 is its first target. It's going to go a lot higher, folks, but right now we're looking at its first target. Second target is right here. So we're looking at that second target. Again, we put this up last week and it had that hit, pullback, retest, up we go. This is next target, and then after that it's going to be 105.93, 106. Those targets are still in line. What does this mean? This means that you can go short euro dollar, short pound dollar, short Aussie dollar, short Kiwi dollar. You can go short those because this thing's going to start to take off. The contractions in dollars is tremendous. You're seeing countries like China starting to offload their bonds. They need dollars. They got to liquidate so they can have dollars to operate. Next, this leads us right into dollar yen. This thing looks like it's about ready to pop. We are getting ready. We are long it already. A break above this one right here at 147.37. A break above that and hold is going to push us up here to this level at 148.82. That's where we're going to go with dollar yen. Once we hit here at this first level, it may create some resistance there. We may get a pullback there before we break it. But once we break it, we move up to that next level. Once we hit that level, we'll probably pull back there and continue on up. This thing has a long ways to go in the coming weeks. The next currency pair we're going to look at is Pound Aussie. Pound Aussie has made a nice lift off of this channel. We're looking for a slight pullback and a move first move up here to 1.9818, then another move up to about 1.98966. If it breaks that level and holds above this resistance zone, the long-term hit is going to be up here at 2.02342. That's where we're going to go with pound Aussie. Now, I know that the dollar strength against the pound weakens the pound. However, because we're not only having a contraction in dollars, we're having a contraction in basically products going out. So Australia is a commodity-based economy. It supplies a lot of commodities to China. If China is contracting, the Australian dollar is going to begin to contract. And it's going to contract a lot quicker than the pound, which is why we believe the pound Aussie is going to start to move higher. So you want to look for those levels this week being hit, these first two levels down here, and then this one up here being hit in the coming weeks. Before we look at gold, let's look at the 10-year. The 10-year came up here, made a perfect top again, and started to pull back. Big resistance area right here. Again, if markets think that the Fed is going to pivot or hold, the 10-year is going to start to head back down. It broke the channel. It has come back. It's retested it. It may go a little higher here, but if this starts to move down and starts to roll over and come down and break this low right here, gold is a long. If it continues up and breaks above this level here, gold is a short. I believe with everything that we're looking at data-wise and so forth, I think the 10-year is going to start to roll over, which means when we go into gold here, there's a couple different ways this can go. This is move down a little bit, about to here. So let's just draw this up real quick. It can move down a little bit more and reverse and break. Once it breaks this channel and holds above it, this is going to be the first target right here. So that's what we're going to look for as the first target, and that sets up around 1958, 1960 area. If it breaks above this level right up here, which sets about 1988, it's going to move to 2016. Be very careful on this. This is the channel in gold, but once we break this level right here and hold above it, those are our two targets. If we don't break this level for whatever reason and hold below it, the next target in gold is going to be 1918. Now, you asked me, would I trade the downside move or not? Well, if I'm a day trader, easy answer to that question is yes. If I want to look for confirmation, I'm either going to look for a solid close, red candle close here, to look to get short down to that level of 1918. Or if I see a reversal and a break above this channel and a hold, I'm going to look for an opportunity to get long to the upside to those targets that we said, 1958, 1960. That's how I'm going to play this thing. Long-term target, if this thing starts going long, which I think it will, 2016. Next, the NASDAQ. I'm not big into formations, but by golly, this looks like a really nice head and shoulders. We get a solid close candle today below these lows right here, the lows 15,446, and that thing closes solid today. Guess what, folks? There's a good opportunity that we could be in a sustained move, albeit with pullbacks, a sustained move down to this level of 1488 before we get a significant bounce on this support level. But if that happens, look for that bounce to roll over and eventually break this thing. I think this thing's poised to head down. Last week, we were down in here. We said if it broke this level here, we're going up higher. We did that. Even if it broke right here, if we got a candle right there, we're going to go long this. We did go long it. It hit target up here. Now we're looking for it to roll over and hit this target down here. Once it hits here, we could get a significant bounce again. You could play around here and then roll over and drop. But you know where my target is. We'll talk about it next week. Again, we're looking for something when we squeeze this up and we bring it together. We're looking at a pretty big move. Let's just pull it back here and we can look at this thing here. We'll draw a channel line. There it is. When we break that, we've got a move that goes clear down to here. That's a pretty significant move. Pretty massive move there before we see a nice bounce. But yeah, this thing, continuation down to the support level here, that's going to be pretty big. Again, we got to break this support level right in here. I am aware of that. That's going to take a little doing. But if it breaks there, that is the target right there. Long-term target. Not happening this week, folks, but definitely could be happening in the coming weeks. To finish up things, we're going to look at volatility, or the S&P vol. We see here we are coming down to support. And what happens is we may come down and hit 12.84. But as soon as we start to get above 14, small caps are really going to start to peel risk off. Above 16, large caps are going to start peel risk off. Where do I think this goes? I think this is the last time we see this for a long time. I think this starts to make its move back up. I think we come back up here. I think we play around there for a while, and then I think we break out. That's where I think this thing's going to. I don't think we break and continue down like this on this. I think we hold this channel right here. There's too many things that's saying that risk is about ready to come off. We've looked at the contraction in lending, which is contraction in dollars. We've looked at the contraction in income. We've looked at, last week, we looked at the contraction in China. All these things are telling us that liquidity in the system could be contracting. So when we look at probabilities, this is what we look for. We try to figure out where markets are going based on data. The data right now says contraction, which means markets should look at risk off. When markets go risk off, that means indices start to contract or head downward. Does it mean we go into another bearish move? Does it mean that we go into a deflationary or disinflation move? I don't know. It hasn't given us indicators to that extent yet. We just got to follow the money. If we look at the commercial lending and what commercial businesses are up against with these high interest rates, we look at the data, it tells us they're in for a world of hurt coming not only 2024, but 25, 26, and 27. To refinance those loans, they're going to have to refinance them at a higher rate. That means they're not going to be able to meet a lot of their obligations. That means a lot of them are going to have to declare bankruptcy. There is a lot on the table here, folks. So I'm just saying, out of all the probable outcomes, these seem the most likely probable outcomes, is that risk starts coming off. Again, if you like what you've heard here, subscribe and like. That way you'll be able to get our videos at the time they come out each week. It'll help you to prepare if you're a trader. It'll help you to maybe view things a little differently and how to set up your trades. If you're just looking for information on how to plan for a recession, great place to be. We encourage you to go and sign up for a free account at www.7xinvestors.com. Come join the community. There's free training there. You can get to know the instructors on all the products. See if you find something that you fit with. And the greatest thing is you can come in there, ask questions, and you'll get all the help you need. So again, this completes this week's look ahead. Good luck in your trading, and we'll see you next week.